G'day everyone, Tony Davidson, Brett Shadow, Azlin and Tony from Pride Advice. Great to have your company. And of course, we are talking about Budget 2020 today. A very significant budget delivered by our Treasurer on Tuesday night. Of course, a huge amount of spending is the big thing you pick up from this particular budget, and not unnecessarily so, given the conditions that we're in. You know, Brett, just to you first of all, any big picture items that you picked up from the budget that sort of really stood out to you?
Tony, I read a headline somewhere saying it was going from ICU into rehabilitation, the economy that is, through this budget, and I think that's pretty much where it is. There were a number of things. I think it was 370 odd pages, and we can't cover all of that stuff off today. But I'm going to focus on the social security and the jobs aspect, and then some of the aged care changes as well during this conversation.
Fantastic. And Azzy, you know, things that stick out to you, obviously we're going to cover the detail over the next few minutes, but initial thoughts on the budget that stick out to you?
There's been significant changes in terms of personal taxation as well as business taxes.
Yeah.
So we'll cover all that shortly.
Okay, fantastic. Well, folks, it's great to have your company. And as always in these discussions, you'll remind you that this is general, not specific advice. Doesn't take into account any of your personal circumstances. Do get advice before you choose to do anything. Now, folks, just in terms of today's outline, of course, we're going to be talking about tax and business incentives there with Azzy, just to kick things off. Brett and I are going to talk about Super, Centrelink and aged care. And then, of course, as ever, the perennial question about whether you can make some money out of the budget and how. We'll just talk briefly about investments. But first, just in terms of taxation measures and what came out in the budget the other day, you know, what were some of the things that you were thinking or picking up there just in terms of personal tax?
I think the biggest one here, Tony, is the income tax cuts for individual tax rates, which have been brought forward. So we originally knew that these stage 2 tax cuts were previously meant to come into play 1st of July 2022. And now, of course, they've been brought forward and to 1 July this year. So they've actually been backdated. So we will see the impact of these tax cuts in our individual returns this financial year. Okay,
that's pretty quick, isn't it? So in reality, we've been working under the new tax regime already for 3-4 months, haven't we?
That's exactly right. And the ATO have actually just clarified that they are looking to, if all things being equal, this gets legislated, they're looking to amend the PAYG withholding schedules so that we ideally will see our net pays increase from Christmas time onwards. So it's a bonus for everyone.
Absolutely. So it's pretty quick, isn't it? All right. And then in terms of personal tax as well, the new low income tax offset, what's going on there?
So the low income tax offset, we say it's new because there's an increase of the maximum offset available from $445. That's been increased now to $700.
Yep.
And this applies to individuals who earn a taxable income of less than $37,000. And of course, that payment is tiered and it's reduced, cuts out completely at $66,000.
Okay. And also the LTMIO, I get my letters mixed up here.
Yeah,
low and medium income tax offset. What happened there?
The low and medium income tax offset, this isn't new. This is something that's been in play since the 2019 financial year. And what that is individuals in the tax threshold from $48,000 to $90,000 are entitled to a low and middle income tax offset of $1,080.
Yep.
Right, this was meant to end last year, FY 2020, but they've just extended it for this financial year, so we get an extra tax relief for this financial year.
Okay, terrific. So for low and medium income earners, end of the day, additional tax offsets there, some complexity about how they're implemented as well, but the big one, of course, and it's been in the newspapers, let's face it, ad nauseum, is just around the tax break, as it were, backdated. That's a pretty powerful mechanism, isn't it?
That's it.
Now, business incentives were a huge part of the budget. Just run us through these business incentives. So we've got outright deduction of capital assets. What does that actually mean?
This is an expansion on the existing instant asset write-off measures that were available to small, medium enterprises till the 30th of June 2021. The difference is, and this is a huge difference, originally, under the existing rules, you can write off an asset. A business can write off an asset up to the value of $150,000. Now, a business can write off the full value of a business asset. there is no limit. So let me emphasize that. There is no limit to the value that can be written off a business asset.
Okay, so theoretically, business buying a big piece of equipment now can write off the whole thing in one go. That's essentially the essence of it, isn't it?
Yeah, that's right. Any asset purchased from budget night to 30 June 2020.
Yep.
The only caveat that I would flag here is that the luxury car cost limit still applies.
Yep.
So you can't go out, a business can't go out, buy a Ferrari, expect to immediately deduct this.
Yep.
You will be capped at that 59,000 car cost limit.
All right. We also have the temporary carryback of losses. Now, this one takes a bit to get your head around, but in summary, how does it work?
This is an interesting one, and this is actually, I think, the most exciting measure for myself, and I'm sure to other business owners, because, not business owners, I apologize, it's actually applicable to companies. Okay, so you need to be a corporate tax entity to be eligible for this. So not applicable to sole traders, partnerships, or just businesses. And what this is a company may utilize current year losses to offset against past profits.
Okay, so it's essentially creating a tax deduction for previous year's profits when this year is a loss.
Yeah, that's exactly right. So what you're really doing is you are averaging out your tax liability over this 3-4 year period, because you're essentially claiming a refund of tax paid on previous year's profits by utilizing this year's losses, because we assume, lots of businesses, they have struggled through 2020. It's going to be quite common that we see businesses in a loss-making position this financial year.
Absolutely. No, it sounds like a good measure. All right, and then the third one here is the job maker hiring credit. Now, also an interesting initiative. It applies to people of a particular age, as I understand it.
That's right, and this is only aimed at new employees as opposed to the existing employees that JobKeeper is targeted at. And I think what the government's trying to do is they're trying to encourage employees to hire younger individuals. So if you hire employees who are between the ages of 16 to 30, you get a $200 weekly hiring credit. If they're 30 to 35, then you get a $100 weekly hiring credit. So that's an interesting one.
It sure is. So there's actually quite a lot in there, not just from a personal perspective, we did it on a previous slide, but just these business incentives as well. So fairly significant impact. So it's been a busy couple of days for you, in terms of digesting all that, hasn't it?
Yeah, absolutely. However, I think these incentives, especially the business ones, they present some really interesting tax planning opportunities. And I know that we'll be chatting to our clients, our business clients at least, about these, because I think there's some really great and interesting things that we can do for them. Yeah, definitely.
It gives those, I think it's all the opportunities that these things raise, isn't it? At the same time, it's a huge amount of work, but there's plenty to go there. All right, that's fantastic, Az. Thank you for that. So a bit of a rundown there just on the tax side of things. I'm going to bring Brett back in now. And Brett, we're talking about super. Now, there were plenty of interesting things that came up earlier in the year, I suppose, about super, but in terms of this particular budget, there didn't seem to be a huge number of these big changes that we'd seen previously.
No, there were a lot of rumblings before the budget. There would be some significant changes to super. There was discussion around super guarantee changing and those types of things, but none of that eventuated. There has been some interesting developments, though, in terms of the proposal for stapling super accounts. And so that means if you go into the workforce for the first time and a super fund is opened up for you, when you subsequently, or if you subsequently move jobs, then rather than adopting your new employer's default super fund, via the ATO, they will find your existing fund and continue to use that fund for your superannuation contributions going forward. So you could end up in a situation where the super fund that you had opened up when you were 18 is the one that you retire with under the current proposal. You still will have choice to make your own decisions as to which super fund you are going to want to use, but there are going to be, it raises some interesting conversations around someone that's working for the public sector at the moment and has a government super fund and moving into the private sector. There's also things around larger employers have their own superannuation funds with generally cheaper fees. And when you move from that employer, you move to a personal division. So I'm interested to find out what's going to happen that space going forward. The other one, the temporary early access to super, that's going to stop at the end of December, but you're allowed to continue to do that for now, but there's no third tranche that was introduced in this particular budget. But if you want to take out up to another $10,000, if you meet the criteria, you can do so for the rest of this year. In relation to the reduction to drawdowns from allocated pensions, that one has confused clients to some extent. What happened, and it happened previously during the GFC, there are minimums that the government requires you take out of an allocated pension when you're in retirement. And the reason there is that minimum is that the earnings that are achieved inside of an allocated pension are not taxed. And so they're very, very beneficial for retirees to have their investments inside an allocated pension. And an allocated pension can only be purchased with superannuation money, hence the reason planners like to use superannuation as part of a retirement plan. So when we're forced to take a minimum out of your pension, when the markets have dropped and they're quite volatile, then you can be crystallising losses. So by allowing people to reduce the minimums by half, effectively allows those funds to stay in the pension to recover over time. And so that's what happened by default if you had already chosen a minimum pension in the previous year. And so we had a number of clients call us and say, hey, what's happened? My pension payments have halved. And that was the reason. So it's just a simple conversation with your allocated pension provider to top the payments back up if that's what you need to be able to live in retirement.
Brett, one of the things that struck me there, thanks for that, is interesting, is a stapling of superannuation funds. And there's some important potential insurance implications there too, isn't it?
There is, Tony, and when we see people, there's some really important reasons why we like them to have more than one super fund. If they're being advised, there's generally method in the madness. And if somebody comes to us and they've been diagnosed with cancer or they're unhealthy, they're sitting in the room with us having chest pains, if they happen to have a life cover, a TPD or an income protection cover built into an existing superannuation fund, then by moving them into a brand new fund, they're not going to get insurance. And so they lose the insurance from the fund that they've currently got in place. And so we've had situations before where we've had a client with 3 or 4 super funds, and it hasn't been good management, it's good luck, but over the years they have accumulated the several super funds, all with a small default level of insurance in them. And because they can't get insurance because of their health, those super funds are really important to retain. And that's been one of the concerns. I understand the reason behind wanting to reduce fees and having a fund, but you are being advised that we do have insurance, and it's a really important thing to take into account.
Yeah, definitely. Okay, and just switching gears here, Brett, just talking also around Centrelink and some of the initiatives, I suppose, announced in the budget there as well. What were they?
Yeah, look, the two $250 payments coming in November and in March, I think it is, in 2021. I think you have to be on a benefit, an eligible benefit, come the end of October and the end of February. The JobKeeper will be running through till the end of March. There was some discussion around that being extended, and I suspect that may still be the case if we do have further breakouts of coronavirus and people aren't allowed to return to work as a result. But what you are seeing is the budget is starting to assume that we are over the hump. In actual fact, just because we've had two spikes, we're not going to have a third, or we're not going to have a fourth. So look, it's going to be really, really, really interesting. The budget has been predicated on not only there being no real further lockdowns of states, but also the assumptions about employment coming back, interest rates reducing. There's been a number of, some people, from what I have read, have said rosy predictions. And it's as a result of that the outcome of the budget is predicated on. The last one there I want to talk about, though, is the granny flat rights. So there's a thing now about dealing with elderly clients and being vulnerable. And what has happened in the past, and we've got a Royal Commission into aged care at the moment, granny flat rights have never been a significant player in this field. There's been obviously nursing homes, aged care, home care packages, those types of things. But to actually have a granny flat right you've had to have a formal agreement to be able to hand money across to a relative and move into the place or have a place erected at the back of their house. And what that has caused in the past up until now has been capital gains tax for what is normally a principal place of residence, perhaps for the children, where there is no capital gains tax when you sell that place. Having a granny flat formal right there has caused the house to be subject to capital gains tax in a lot of cases. So what's happened to get around that, people have not had formal agreements in place. They've just had an informal agreement. But what's happened is whether the daughter or the son have a marital split, then it causes all sorts of problems. And so these elderly people that think they've got a home for the rest of their lives, all of a sudden the house needs to be sold, or the payment that was made gets mixed up in the separation. And so people have flown under the radar and done this informally. So what the government's saying now is they're trying to encourage people, yes, definitely have a granny flat right, look after your elderly parent, and you can actually have a formal agreement in place which protects them, and we will not subject your house to capital gains if you sell in the future.
Brett, that's a much bigger deal than it appears to be at face value, and it's not just the capital gains tax implication here, really. It's more about the legal right, isn't it? And that's, as you're talking about, not just from an aged care Royal Commission perspective, it's a fundamental right. And you see it go on in a lot of families in terms of the transition. Mum or dad move out the back into the granny flat, the kids move into the original house. It just helps the family and everyone wants to progress. But the dynamics can change, and the legal implications and ramifications for some families, really, that can be terrible.
Absolutely. And when you think about having an ageing population, as we do in Australia, culturally, we haven't had mum and dad move in the house with us very often, but other cultures have done that very, very well. And when you also read about the aged care facilities and the coronavirus, it could be that going forward, an increasing amount of people would prefer their elderly parents to move into a granny flat erected at the back of their existing house than the costs to go into an aged care facility. So I think it could be something that is taken up more and more, and just shoring up the fact that you're not going to be subjecting your house to capital gains tax in the future is not a bad thing.
Yeah, definitely. Okay, and so Brett, Azlin, just sort of bringing that back in, we've talked there about tax and some of the big implications there, Azzy, just in terms of personal tax and obviously business tax, and Brett, just on the superannuation front. If you guys had to wrap it up and summarise it, I suppose starting with you, Azzy, what's the big takeaway from this budget for you?
The major one for personal taxes is, I think we'll see that this financial year, FY 2021, there will be additional tax relief. So that's a little bit of a bonus for families and singles in terms of their individual tax returns. And for businesses, you can really see that the government's trying to invest in jobs and these small businesses, small to medium businesses, to encourage sort of spending in some sense, but also the creation of jobs. Yeah,
definitely. And Brett, what about for you? What do you pick up as the big agenda items that came out of this? Was it just the tax cuts, because super wasn't really touched? Was it Centrelink? Was there anything that stood out for you?
Look, in terms of Centrelink, not really. A lot of the measures are already out there in the public forum, so there wasn't a lot of new stuff there. But this budget, for me, has been about giving money back into the pockets of households to boost demand, and to also try and lift growth so that we can get back on track with employment and those types of things. I think what may happen going forward is there were a lot of potential changes to superannuation and what has typically been default super before. You've got the industry funds, you've got the retail funds, you've got the self-managed super funds, and I think that could get a little bit confusing for people that are trying to do this themselves. And now when they're talking about this new ATO tool, the Your Super tool, or doing the annual performance tests, it's going to be very difficult to compare apples with apples, because the way some super funds regard infrastructure compared to other super funds, and then trying to benchmark that into a performance league, it hasn't been an easy job to do under the My Super rules. And I read with interest that since My Super has come out, fees, even though the My Super pot of money has perhaps doubled or tripled, the fees have also gone up. So there's been no economies of scale with that. And I think it's going to be really interesting to see that unfold and to see the debate happen in Parliament as to what actually, from what it was announced, what becomes law.
Yeah, I think you're right, Brett. There's a huge amount to play out on that particular front. And look, a lot of it, folks, is industry related, but it's going to have a tremendous impact down the road in terms of the way you can invest. But really importantly, to Brett's point, it's the taxonomy and the way that, in fact, that these funds will be measured and then benchmarked against each other and the implication for those funds. That is actually quite a big deal. And I think it'd be worthy of a whole nother discussion at some point, Brett, especially when the dust has settled on some of the detail. I'd say that the devil here absolutely is in the detail, and that's really ahead of us. These initiatives, from recollection, I think I read, won't really start. We're talking about these particular initiatives on the 1st of July 2021, but even that, only 9 months away. There's actually a lot of change to absorb in a very short period.
There sure is, Tony. And when you think about what's happening in the economy and what we're still dealing with and a US election coming up, I would be interested in your views as to what you think this budget means for the economy.
Well, Brett, thank you for that. That's a fantastic segue. So just in terms of the perennial question there about, can you make money from this? What's the budget impact on investments? I think I'll give you some big picture and very quick insights. The way the investment committee sees it is firstly that this is fiscal response and it is enormous. And just to stress the word enormous, it is an enormous initiative, an enormous amount of spending, a huge amount of debt. The numbers are all huge, but importantly, they're being replicated by pretty much every government around the world at the moment. What that simply means is that the old-fashioned tool of lower interest rates, which, let's face it, they can't really get any lower than they are today, is being rapidly displaced by the government. And so that's something to firstly consider, is that the government really now is the big stimulator in the economy. And in terms of where you can make money out of something like the budget, of course, the first thing that comes to mind is your infrastructure and so forth. But certain sectors like retailers stand to do a little bit better, you would think, just given the tax cuts that are coming through. All fairly logical stuff. And if you think through the flow-on impacts, well, that's where markets are already starting to reprice some of those opportunities coming ahead. So that's the first one. I think the second one too, though, and just moving on to our next slide here, is just which economies at the moment in the COVID environment we've got are expected to bounce back sooner. Now on your chart, on your page here, you've got a copy of a chart, and essentially the yellow line reflects the Australian share market, the red line is the US share market. This is in Australian dollars, but the important thing here is that this starts on the 1st of January this year. What markets essentially are telling us is that they expect the US economy to bounce back sooner to pre-COVID levels. At the moment, analysts are pricing in earnings in the US share market to probably level out with those from a pre-COVID phase at around about the end of 2021 or early 2022. And as for the Australian market, well, it's well further down the road. So the one thing to also note here again is that markets are expecting the US to come back a lot quicker than Australia. And again, it's starting to get priced in. And that sort of explains also, from an investment standpoint at the moment, so much of where we're investing is in fact offshore. That will continue to be the case, and in fact we're looking to enhance that focus over the next couple of months with some changes to the Sustante portfolios that we'll refer you to somewhere down the track. But in summary, right now we see a lot of upside risk. Of all things at the moment, the market continues to absorb the bad news that's coming through, the US election and some of the near-term issues, but the huge amount of fiscal spending is really propping things up, and we expect to start to see global growth return in 2021, and all else considered equal, I'd actually have to say from simply a market standpoint, this is not an economic comment so much, but from a market standpoint, things are a lot better than were expected only a couple of months ago. So Brett, to your question though, in terms of near-term risks, they are always prevalent from an investing standpoint. And just on the page there, as we can see, there's no end of things that you could be worried about, be it whether a vaccine emerges for COVID, the US versus China or China versus the rest of the world from a trade standpoint, the social situation in the United States, the list goes on. There's plenty to be worried about, but we see an emerging level of resilience coming through in markets at the moment, and that fiscal support and the ongoing monetary support really sort of underpinning things. And we think, all else being equal, recovery and so forth and COVID blow-ups aside, we're seeing, I suppose, the signs that perhaps that could be sustainable through to the middle parts of next year when, of course, hopefully things start to improve from a COVID standpoint. So that's sort of the very quick market summary at the moment. But Brett, that considered at the moment, do you have any personal views about the way clients should be investing or the way they should be, I suppose, positioning at the moment?
Not really, Tony. It's I'm having a lot of people question about what they should do with deposits. They're getting nothing, and it doesn't look like they're going to get any better anytime soon. But I read with interest an article, I think it was for the Barefoot Investor, talking about don't spend, save, and make sure you've got money put aside for a rainy day. So look, I also hope that people have got sufficient cash put aside, and certainly within the portfolios, we've already structured that type of stuff. So whether it's at the right time to invest, I think we've spoken before about dollar cost averaging rather than just chucking one pile of money in, that you can help do that. The downside is if the market does take off, human nature is to wish that you had more in the market when it was lower than when it was higher. It's just the uncertainty at the moment. It's so difficult to work out what to do. I think diversification is key. And as we've spoken about in terms of retirement, it's really not about money. Get out there, walk, get your exercise, be healthy. That first slide that you put up about what people worry about, work longer, cut down your hours and spend more time with the family, do some local touring and just do some other things that keep you busy, and just don't watch the news and read the papers.
Yeah, it's as my wife often reminds me, focus on the things you can control. Isn't that true? So that's good. No worries. Well, Brett, thank you again for your time, and Azzy, a great summary there on the tax side of things as well. It's an interesting budget, folks, for so many reasons, as we just sort of talked through. Plenty of those initiatives, Azzy, from a tax standpoint, you'd be working through those with your clients, and Brett, I know that you and the team and I were all sort of working through the implications for our clients as well, although from a super standpoint, not so many in this particular one. Any parting thoughts there, Brett, at all, just for the folks who are watching?
Look, I think just to make sure that you've engaged with us if you've got any concerns whatsoever. We also encourage you to get your friends and family to come and have a chat with us. It's amazing how many conversations are had over a glass of red, over a barbecue, and there's some misconceptions about what budgets mean. And so, it's one thing for the clients to have us to be able to come to, but they are being inundated with different interpretations. And I think you're going to see tonight, or no, last night we had Anthony Albanese talking with the budget reply, and so there's going to be some stuff coming out of that. And so it's really going to be a matter of trying to get to the actual truth.
Yeah, definitely. And as any parting thoughts on the tax front, now's a good time really to make a phone call, make a time with you guys and do some planning. I mean, let's face it, we've got retrospective taxes. How often do you ever get that in your life? The opportunity to create refunds from past profits, you're never going to see that again, are you, surely?
Yeah, absolutely. So just to echo Brett, we'd love to hear from you. So give us a bell. There's no question that's too silly. So get in touch. We'd love to chat.
Fantastic. Well, Brett, as always, guys, thanks very much for that. And folks at home, drop us a line if you have any questions. We'll see you all again soon. Bye.
No problem again.